QuickBooks Pro Plus Desktop 2022 OneNote presentation, add new accounts, and opening balances. Let's get into it. We're into it. QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, we're in the icon left-hand side, topic introductions, 6380, add new accounts and opening balances. Also, take a look at the Immersive Reader tool, topic introductions, also in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple languages, either listened to or read in them. Same name and numbers, presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with the presentations if you don't have access to the software at that time. Closing the icon on the left-hand side, we're looking at the adding of new accounts, starting out with a screenshot of the home page. Here are our beginning balances that we're trying to add into our beginning balances for our worksheet in QuickBooks. We went through some of the more difficult accounts in the past, including accounts receivable, inventory, accounts payable, them being more difficult because you need subledgers related to the inventory items, the customers, and the vendors. Now we're going to add some of the other accounts, which should be a little bit easier to do. So this is where we stand in terms of the trial balance. To start off with, we got the accounts receivable, the inventory, the accounts payable, everything else being dumped into the equity in some way, shape, or form, either going into the income statement or being dumped into opening balance equity. That is the plan. We will then adjust the opening balance equity at the end of the process. If you go to the lists drop down and go to the chart of accounts, we can go into the good old checking account here, double click in the checking account. You see that it does have an opening balance button that we can use, unlike the accounts payable and the accounts receivable. So we're going to go into that opening balance and into that beginning balance number as of the end of the prior period. That should increase then the bank account. The other side then go into most likely opening balance equity, as QuickBooks puts the other side somewhere, most likely opening balance equity. We do have to worry about the bank reconciliation here with the checking account, but we'll deal with that when we get to the bank reconciliation process, meaning the amount that was on the ending balance of our prior set of books may not match the bank statement due to the fact that we have outstanding deposits and checks. We'll talk more about that later, but for now, we put that in place. There's the checking account. The other side got dumped into most likely this opening balance equity account. Continuing on, we've got the furniture and equipment and the accumulated depreciation we need to set up. So we've got the furniture and equipment account that we're going into from the chart of accounts. We have the opening balance button once again. So we're simply going to be adding that as of the last period, the last day of the last period. So we're ready to go as of the current period, which is going to be January 1st, 2022. So now we have it in place. There's the furniture and equipment. And QuickBooks most likely dumped the other side once again into opening balance equity, which is good. It's all going according to plan. Then we got the accumulated depreciation we can add from our beginning balances. So here's the accumulated depreciation. It's a fixed asset type of account. We're just going to enter the opening balance there. We got nothing stopping us from doing that, like subledgers that are going to mess us up. So we got the $7,500 in the opening balance. You got to be careful on this one to decide whether it's going to be a positive or negative number, since it's a contra asset account. So if you put it in there the wrong way, you could just flip it. That's kind of the problems with not using debits and credits, but we'll put it in there as of the same time frame, and we'll then, hopefully once we get it settled out, it's in place. Notice it's in place. I put it in there as a debit, so it's actually not in the right place right now. It should be a credit. So then I would go back in there and flip it, meaning reverse the debit and credit would be in there as a debit, make it a credit, or put a negative sign if you're in the ledger. Again, that's kind of the problem with not using debits and credits. The plus and minuses can get a little confusing at times, especially with those contra asset accounts. But we're gonna move on, and then we got the payroll liabilities, and then we got the next item is going to be credit card. So we're adding the credit card now. This is going to be a new account that we're setting up as a credit card, hitting this rise up here, new account, credit card type of account. It's going to be the Visa, it's going to be the account name, credit card type of account, and again, we have the opening balance little button that we can use to put that $1,000 in from our opening balance as of the last day of the prior period. So it's good to go on the first day of the period we will be working, January 1st, 2022. There it is, the Visa liability account now in place. Notice that we fixed the accumulated depreciation at this time, which should be a credit by reversing that. Now we're going to continue on to the loan payable. That should also be easy. So we're going to make a new account. Looks like we don't have a loan payable yet. So we're going to go to the account rise up, new account, loan type of account. And then we're simply going to type in loan payable for the item. It does have an opening balance type of activity here. So we're going to enter the opening balance at the $22,000 as of the last day of the prior period. And now we've got the loan on the books, the other side being thrown into most likely opening balance equity. So we got this junk down here in opening balance equity and the uncategorized income and expenses, those being there as of the last period, as of 2021. We're starting January 1st, 2022. So if we run this report for 2022, these two things will go away and we won't have any income statement accounts. Everything will be in equity, but it'll have this ugly opening balance equity that we'll need to adjust for later. So here we have our check numbers, so we can check what we have in our system compared to what we wanted to have. Everything looks good except for this mess down here in the equity section, which we will fix shortly. It's not a problem. Notice that if we collapse this item, this is looking at the trial balance, and we have the equity down here because I'm in 2022 now. So we don't have now down here the uncategorized income and expenses, but rather they're just in owner's equity. We still have this ugly opening balance equity account that we're going to adjust for in a future presentation. Now, if we did this with just journal entries, we could see the same kind of thing just in terms of an accounting setup. We would have the trial balance. This is where we left off last time. We're going to add the checking account. And so if we just kind of mirror what we did, adding this one thing at a time, the journal entry would be a debit to the checking account, credit to the equity account. I'm not going to put it to opening balance equity or any other kind of income statement account. I would just put it to the equity to kind of mirror the same concept so that equity will wash out and be correct once we do all of the accounts. So we increased to $25,000. The other side then went down here to the equity account. Checking account now went up in the GL by the $25,000 to $25,000. We've got all this activity in the equity. It was at $8,396, went up by the $25,000 to the $33,396. Then we added the furniture and equipment. So we're just going to do the journal entry. It's an asset, so we're going to increase it by $75,000. The other side, we're just going to dump into equity. Same kind of concept. So you can see here that then we increased the furniture and equipment, $75,000. The other side went into equity. If we looked at the journal entry, it would be an increase to the furniture and equipment to $75,000. Equity was at the $33,396. We increased it by $75,000 to $108,396. Then we're going to increase the accumulated depreciation, that being that contra asset accounts. It's an asset account. In other words, it has a credit balance to it, decreasing the assets as it goes up in the credit direction. That means we need a credit of the accumulated depreciation, debit to equity this time. So here we have it. We have a credit to the accumulated depreciation now. The other side went to equity. If you look at the GL account, now equity was at $108,396. We debited it, which is going to decrease a credit balance account, taking it down to $108,996. The accumulated depreciation went up in the equity direction, which decreases the total assets because it's a contra asset account. Then we've got the Visa, which is a liability account, increased with a credit. The other side going to equity, a debit. So we had to put the Visa on the books. Liability account down here increased with a credit. The other side went into the equity. So if we look at equity now, we have the $108,996, and then we decreased it by $1,000, bringing it down to the $99,896, matching what we have up here. And then the Visa went up to the $1,000. Then we got the loan payable. I believe this is the last one. It's a liability. We increased it with a credit. The other side we just dumped into equity at the $22,000. So now we got the loan liability increased to $22,000. The other side got dumped into equity. Equity should now be what we want it to be because all of our other accounts are what we want it to be. And we put everything else to equity. And therefore, due to the double entry accounting system being in place, that last number has to wash out and be correct as long as we were taking the balances from something that was currently in balance that we started out with when we entered the data. So now we have the equity that was at the $99,896. It's going to go down because we're debiting a credit balance account by the $22,000 to the $77,896, and the loan payable is going up by the $22,000 to the $22,000.